Hello, and welcome to another episode of Fractional Futures, where in this season we're exploring how fractional CMOs can help SMEs and portfolio companies accelerate growth and maximize enterprise value. Today, we're going to be discussing one of the most understood yet powerful drivers of business success, and that's brand equity. A strong brand is more than just a marketing asset. It's a key contributor to customer loyalty and also long-term profitability. In this episode, we'll be exploring how brand equity impacts business valuation, when to consider rebranding to support growth, and how to measure the financial impact of branding initiatives. Joining me today is Rob Nicholls, a strategic CFO, a non-exec director, and a board advisor with over 35 years of global finance experience. Rob specialises in profit maximisation and value creation, and today he'll be sharing his insights on why CFOs are increasingly recognising the value of brand equity. Hi, Rob. Welcome to the show.
See you, Paul.
What have you been up to recently? Anything exciting? Any news?
A little bit of travelling, a little bit of golf. The weather's getting better. We're getting out there a little bit more as well, so all good.
Has your handicap improved?
The objective this year is to drop 2 strokes.
Right.
That'll be good. I'll be happy with that.
So let's jump into the first topic, where I want to explore how brands can be a strategic asset for a company. Now, a strong brand is more than just a logo. It's an asset that drives revenue growth, customer loyalty, and enterprise value. I want to explore how brand building can increase profitability and attract the right investors and ultimately customers. So, Rob, from your financial perspective, how do you evaluate brand equity as an asset? And what role does it play when assessing a portfolio company's valuation for investors or stakeholders?
The difficulty I think we have with brand and brand strategy and the value of brand is it takes time to accrete or develop, if you will. So it'll take sometimes months and certainly years to develop. And that's difficult for a lot of people, a lot of traditional finance directors, perhaps, to value, if you will. I think that's the dilemma for a lot of finance directors, if you will, is finance directors tend to be more inwardly focused, more backward focused around reporting, delivering the numbers. A chief financial officer really is forward thinking. It's looking at where the business is going, where the market is going, and where value can be created. And a big driver of that, and I as a CFO recognize that, is around brand. But the important thing to recognize, I think, with brand is it takes time. You know, you're not going to spend 20,000 this month and create an improvement on customer retention, new customer growth, and better pricing in the next quarter. It's going to take several quarters and in some cases several years. And that's an investment over time that is difficult to justify sometimes to a board, to a CEO, to a CFO even, because it will take time. And the other thing is it's intangible. It's not something I can't touch and feel it like a new building or in a new vehicle fleet, if you will. That's the intangible asset. But to be honest, today, most highly valued businesses have a tangible brand that you can't touch and feel, but has value in the marketplace that brings clients to the business, that perhaps enables premium pricing. And that truly is valued. And you can see that readily in the public markets, if you will. And the same goes for the private markets. If you've got a public brand that has value in the marketplace, the business tends to be highly valued. In the same way that you can have a private company with a strong brand in a strong industry or strong product or service that will be highly valued by investors. And so, you know, if you're creating a brand that has traction, has resonance in the marketplace, and that maybe is only a regional brand that you want to take nationally, perhaps, or even regionally, investors will look at that brand and that creation of brand equity, and they will value it accordingly. You know, valuations of companies aren't just multiples of EBITDA or a multiple of sales. They will also ascribe value to the brand that they'll understand through their due diligence, through talking to customers, through talking to industry contacts. They will evaluate the value of that brand in the marketplace. And quite often you'll find that, you know, a business that might sell for 15 or 20 million pound, you'll often find that there are very few assets other than sales, maybe a client list, and a brand. And that brand does equate to a significant amount of value. And investors see that, acquirers will see that. And I think the boards today, CEOs, CFOs, and the board will recognize that if you're creating value, you're increasing the overall enterprise value of the business. And brand has a big part to play in that. And I still don't think it's probably fully recognized.
Absolutely. I think a lot of marketing leaders, when they're tasked with a brand project or brand activity, a lot of it is focused on the brand identity, changing the fonts, changing the colors, maybe changing the logo. That doesn't really add pound signs. It doesn't increase EBITDA, it doesn't increase enterprise value. Where a strong brand drives demand, if it drives word of mouth referrals, you can use it to lower customer acquisition costs. That's what boosts profitability. And I think the modern marketer needs to be thinking, how can I leverage the brands that we have? How can we make it stronger? How can we draw more eyes onto it? How can we create brand power?
And then I have a couple of brand strategists in my network that I work with, some really, really good people as well, that can develop kick-ass brand strategies, that they can talk to the values and the nomenclatures that CEO and the CFO want to talk about long-term value creation, incremental clients, incremental pricing over the longer term. And that's what it's all about, really. It's about creating value over the long term. I'm not really looking at brand strategy and saying, what's going to do for my sales this quarter or even next quarter? It's over the next 3 to 5 years, 5 to 7 years. Is it going to be part of the value creation within the business? Is it going to lead to more individual clients, more customer wins, higher conversion rates, longer retention of clients within the business? Do they feel good about doing business with the company or with the product and service we offer? So it's not really widely understood, I would suggest, because most managing directors or CEOs, they often haven't studied marketing. They don't understand the value of marketing. They don't understand the value that can be built and created through a strong brand strategy. And I don't think brand strategists, to be honest, do a very good job of selling what a brand strategy is and how it can generate incremental sales, incremental client opportunities, more partnership opportunities, better pricing, and therefore better margins, higher profitability, and therefore value creation. I really don't think brand strategists do a very good job. They work in their own little world, or their sandbox, if you will. They don't see the bigger. The best ones do see the bigger picture, what the opportunity is, and they speak the language of the client in terms of what the client is looking for. And it really isn't about colors or fonts. I think we've moved past that, and the brand strategists that think it is, they're going to be left behind.
Absolutely. And I want to give a shout out to a brand strategist who is world class, and that's Graham Robertson, who's the founder of Beloved Brands. And he talks very much around generating brand power. So by having brand power, you can command a pricing premium. You can create more bargaining power in the supply chain. You can attract partnership opportunities where you can lower customer acquisition costs. And that's really where an investor and the CFO will start seeing the value of the brand, is through lowering costs, but increasing lifetime value, average order value, that kind of stuff. If you're listening or watching this, give Graham Robertson look him up on LinkedIn, have a look at Beloved Brands, because he does a fantastic job of explaining how to create brand power.
And you have to think about this as an investor as well. If I'm looking to acquire your business, what am I acquiring? It might be a contact list, a customer list. It might be potential sales going forward. But you're also really acquiring a brand, and that brand, if I buy it, is going to sit on my balance sheet as goodwill, and that goodwill is going to be appreciated over a period of time, 10, 15, 20 years potentially. So there has to be long-term value in the brand and the resonance in the market marketplace, because if you're going to depreciate, it's just like buying a piece of plant, a factory. It's going to be depreciated over time, and brand will be depreciated over time. We'll put an expense every quarter into the P&L for that. So if you think about it that way, as an investor thinks about it, I think you'll be better placed anyway.
Yeah. I want to move on now to the next topic, Rob, where I want to explore rebranding for growth. There's a lot of companies out there that all of a sudden they want to rebrand for no logical reason. Rebranding, it can be a powerful tool for driving growth, but only if it's done for the right reasons and with measurable results. And I want to break that down slightly. So if you're committed to a rebranding project, how does it deliver long-term financial impact? So Rob, in your experience, what are the financial and operational factors that a company should evaluate before committing to a rebrand project, and how would you measure its success?
I think if we talk about a rebrand being more than just colours and fonts, if you will, it has to deliver. If I'm going to spend £100,000 on a brand, on a rebrand, it has to deliver incremental value to the stakeholders of the business. So that's improved pricing, better margins, increased revenue, higher retention, longer lifetime value of a client. And so it has to create something that has some sort of semi-permanence over a longer period of time. So, if I'm going to do a rebrand, I want to spend a decent sum of money. A rebrand isn't 5 to 10 grand playing with numbers and some images, if you will. A rebrand is 50 to 100 to 250. That's maybe a 6, 9 month, maybe a 12-month project, if you will, that engages existing clients, potential clients, internally, all the stakeholders. You've got to do it properly. I was speaking with someone, a recruiter, a couple of weeks ago, and she's done a rebrand. She's done it all in-house, cost them £5,000 or something. That's not a rebrand. That's just changing some fonts and doing some blogs, if you will. So that's fine, and we'll see how that works out for them. I want to see a rebrand that actually brings manifest changes to the business, not in 30, 60, 90 days, but over 1, 2, 3, 5 years. So whether that's a complete name change, whether that's a complete image reappraisal, whether that's a new pivot to a new marketplace. One of my clients works in the build environment, and we're doing a big pivot into an area where we know there's a pot of money because it's government money, and there'll be several $billion that will be available for our clients to go after. So there's a rebrand to be done around focusing part of our business on that pot of money, because we know it's there, we know our clients can get it, and we need to move to that in that direction. So we're investing knowing that there's going to be a marketplace with resonance and with a pot of money there. And I don't think enough businesses do that. And you can do that whether you're turning over £500,000 or 5 million or £50 million a year. There's no restriction on that. I don't see UK businesses rebranding or having a brand strategy very often. If I work with 10 clients, maybe 1 or 2 of them will be cognizant of brand. Whereas I worked in the US for 25 years, most every business, small, large, or in between, they all had a brand strategy, whether it was documented or not, likely they did. They will often have an external agency to work with their internal people. They take it seriously. It's taken very seriously, brand and brand equity. That's why you'll find an awful lot more, of the top 50 brands, probably 45 of them today are US-based brands, because it's taken seriously. There's investment. We talked earlier about putting, a percentage of sales into your marketing or spend, if you will. And it's the same with brand. You should be making a significant investment in brand, because your clients will benefit from it, your pricing will benefit from it, and potential people or potential acquirers of your business, people who will value your business, will value that as well. So, look at it it's an investment. That's what it is. Brand is an investment. And if your CFO is not recognizing that, they're probably not a CFO. They're probably, a finance controller or finance manager, perhaps, has assumed the title. A true CFO will recognize that a brand strategy is an investment in the business, and it's not something that's going to generate tangible improvements or an inflection of sales or profitability in the next 30, 60, 90 days, but generally over 1, 2, 3 years, there's going to be attribution of value to the business.
In my career as a marketer, that there's been a few companies or a few employers that wanted to do a rebrand purely for aesthetic reasons, and I said, don't do it. It's not going to deliver any long-term financial benefit at all. And I think a lot of business leaders need to understand when a rebranding project should happen, and it's all about timing. So if your competitors are gaining a market share over your company, a rebrand can help you reposition yourself in the market, regain your competitive edge. The other trigger point, and one of my clients is considering this at the moment, is a merger and acquisition. So if you're an organization and your growth strategy is buy and build, if you're acquiring these new sub brands, you might want to consider what brand architecture you go with. Do you have a unified brand that all the sub brands are part of one? Or do you have a house of cards architecture where they all remain as independent brands, and that brings its own challenges as well? But having multiple brands, it might confuse the market. So again, you need to think about the market impact, both for the customers and potential investors. And the other trigger point, of course, is brand fatigue. If we look at Jaguar recently, there's been a lot of noise about Jaguar, and that's probably one of the most obvious brands at the moment going through a big rebrand. And I think this brand fatigue or negative brand perception is quite true of Jaguar at the moment. There's a lot of heritage and goodwill thought of Jaguar, but it's completely tearing up the rule book. It's coming up with a completely different product. It's completely repositioning itself in the market because there is that brand fatigue. So I think if your business, if it's not facing brand fatigue, if you're not going to new markets, if your competitors aren't stealing market share from you, there's no need to rebrand. If you're just going to do it for changing your name or changing the colors or having better pictures on your website, don't do it.
It's an interesting one. Jaguar is a case in point. There'll be Harvard case studies on that for years to come. I'm a big believer in the acquiring sub brands, if you will. I call them. We used to have a strategy called string of pearls, and you basically add a new business, which would be a new brand, as a sub brand, and then investing in that. I think there's a lot of value in that. I think anytime you acquire something and then just suddenly strip the brand and integrate it in and bolt it on and give it the master brand, I think there's an awful lot of brand equity or goodwill that's lost. So I'm a big believer in, if you acquire a business, and one of my businesses was acquired a year before last, and the acquirer did a smart thing, is that they didn't really touch the brand. So it's just a sub brand. There's an umbrella organization that owns the sub brand that we sold the business to them, and that's worked very, very well. A lot of opportunities to partner, but they're really hands off. We do a quarterly board meeting where we basically report, myself and the managing director report what's happened, what the numbers are, what we're trying to do, and they're very hands off. And that model works very well. I'm a big believer in that, what I call string of pearls approach. And the acquirer, in this case, they've acquired probably 3 to 4 other businesses over the last 5 years, and they've all worked very well, and they've all retained their own sub brand and invested in that sub brand. So there's value in that as well. And then there's the Jaguar approach.
Yeah. And I think that operating as those sub brands where they retain their independence, it brings advantages and it brings disadvantages as well. Because from a marketing perspective, it's more complicated to manage those multiple brands. You've got the cultural piece as well. All of a sudden, if you've got 4 or 5 brands, you've got 4 or 5 different cultures. So organizationally, how do you manage that? I think the other thing as well is whenever you're going through an M&A process and when you're deciding on the right brand architecture approach, whether it's House of Cards, unified, sub-brands, whatever, you need to be thinking 5-10 years down the line, because that sub-brand you've just acquired, what if you want to divest that sometime in the future? So if you bring in a brand and you put that under a unified brand, if it doesn't work out, if you want to sell it, it might be harder to sell if you didn't retain it as its own original brand. So you need to think, again, brand architecture, brand strategy, it's more than just colors and names and stuff like that. It's really about what is the future strategy of the business. If the owners want to sell out 10 years down the line, what's the impact of that? If you approach it in the wrong way, you can jeopardize quite a lot.
There's a lot of value to be created. As an investor, I'm very keenly, looking at the acquisition strategy. If I'm looking to buy companies, I'm buying the brand. An awful lot of what I'm buying is the brand and the senior leadership. So I will retain the senior leadership for 2 or 3 years of earnout, but the brand is going to be there when those leaders have gone. So it's what I'm buying. Does it have longevity? Have we done the due diligence? Does the brand have resonance in the marketplace? Can you take that brand to other places? So it's a fascinating world, and I think it's something that's undervalued, is acquiring sub brands and investing in those sub brands. But equally, the long-term approach. You have to be, as you say, you might acquire a business next year, but in 10 years' time, you may look to spin it out because maybe the business has grown substantially. Maybe they pivoted sometime, and maybe the management team that you put in that business wants to go off and do their own thing, and there's value to be created there, and that's absolutely should be invested. And one thing I wanted to go back to is, a lot of this is a zero-sum game. Being on the board, CFO, CEO of the board, they're allocating capital. So the more brands you've got, if you've got £100,000 to invest, you've got 10 brands, you've got to share the money around, Whereas if you've only got 2 brands, each brand is going to get a lot more investment. So the decision is capital allocation. The more brands you have, the more sub brands you have, the less money is going to be available to that brand. So, it's oftentimes a better alternative is if you've got 100,000 to spend it on one brand than spreading it too thinly. So it's all about capital allocation and making the right decisions with the capital that you've got to be able to allocate.
That's probably a good segue into the next topic, measuring brand equity impact. You mentioned earlier, Rob, that brand equity is often intangible, but the financial impact is very real. So I want to explore now how to measure the ROI of branding initiatives, because it is a hard thing to do. And so from a CFO's perspective, when working with the CMO or the marketing leader, what financial metrics are you looking at to determine whether the brand investment is translating into tangible business outcomes?
So, in the US, I work with a number of hoteliers, and I work with one private hotel group, and we worked together. We acquired a number of hotels and then rebranded them. Now, the interesting thing was that they took a very long-term approach. They took a 3 to 5 year attribution approach. So they weren't really looking for pricing to kick in straight away, although it often did. You can take $100 hotel and rebrand it as a $300 hotel, but that will take time to get occupancy up as well. So in that case, that was about average revenue per key. So you acquired a hotel for £150,000. You can rebrand the hotel, and suddenly that key, that room effectively, is going to generate $450,000 worth of revenue as well. So that is a tangible, manifest, incremental inflection point. Now, it may not happen immediately. In the case of hotels, often it does happen. You can put your room rates up literally the next day. Not a lot of businesses operate that way. So I think there's a fatal flaw in that there's an expectation from the board, effectively, sometimes, is that it will have an immediate impact. I don't think that's the case. I think in a lot of cases, you'll find whether it's a product or a service, whether it's an accounting firm rebranding, there won't be an inflection point in the next quarter. You won't see a significant uptick in new client opportunities, a higher conversion rate, higher rates. It will take time to attribute. And I think, a 2 or 3 year timeline would often be a good timeline to look at. And so, you have to have some key metrics. And I think the one that always resonates with me is if sales or revenue per employee. If we've got 100 employees and we're doing £100,000 worth of revenue, that's a revenue per employee ratio that maybe is a baseline. So, if you're growing as an organization, you may be bringing on 10, 15% of additional staff every year, every other year perhaps. You need to have the metrics that look at that key KPI that is growing. So over time, sales per employee should be growing every quarter, certainly every year. If you're running 6 or 8 distribution sites, if you're going to increase them by 2 and you're going to increase your sites by say 20 to 25%, you need to see a material inflection of sales or revenue per site. So pick a number, whether it's employees or locations or distribution points, and pick that revenue point and make that the metric of choice and report on that internally and externally. So if the board says we want to look at revenue per hotel or per restaurant or per distribution point, fine. Have that same resonance inside, communicating that inside so that people on the team know that the senior leadership is looking at revenue per whatever that is, and make sure it's communicated well. I worked with an organization that did not do that very well at all. So the board was working on revenue and profitability and pricing on a unit basis, and they weren't communicating anything at all internally. So the 50 or so people within the organization really didn't, they were just focused on their day-to-day job. They weren't really focused on the bigger, wider issue for the organization. For about 2 years, we're getting there now, slowly.
Brand equity, it can directly impact the valuation of a business, particularly during an exit or an acquisition. But when I was in the corporate finance world for a short time, when companies were being valued, a lot of effort was spent looking at the brands, the brand equity. How attractive was it? What was the market pull? And that can add, a few more multiples to the valuation price. So if your founders or co-founders are looking to exit, maybe a rebrand project before a sale can increase a multiple, which is obviously a good thing.
It's a good point. I'm working with a client right now who have an expression of interest from a third party in Europe. And we're at the moment trying to get our ducks in line, both financially and from a brand image, to basically reduce the multiple. Whereas we might be able to do a transaction at 3 or 4 times sales, my objective is to try and get that to more like 5 or 6 times sales. So right now it's about pedal to the metal in terms of revenue, but it's about branding and it's all those other things. They've got a good brand. It's about making sure that brand has the full investment. So we've actually brought on board a freelance marketer to invest in that brand, because the objective is in the next probably 12 months to get an expression of interest with a tangible, here's an offer from a third party. And the objective, the mindset as the CFO is, I want my directors to generate a significantly higher multiple than they would have done 2 years ago. I've only been with them about 2.5 years now. And it's all around putting our ducks in line, get a higher multiple, because we know there's a transaction likely to take place in the next 18 months. And I'd rather they have 12 to 15 rather than 6 to 8 as a number to divide amongst themselves and go off and buy a boat and sail around the Mediterranean. My objective is to maximize that value. And so we're doing everything we can right now to invest in the brand, to make sure it has resonance in the marketplace, to make sure that customers really appreciate it, to become the number one provider of that service in the UK, which is why we've got an expression of interest from a company in Europe. So really now it's about investment in the brand, making sure we get our ducks in line, both financially, sales, customers. Customers have great things to say about it, but it's about investment. And it does take time. It's taken 2.5 years to get to this point, and it'll probably take another year. So we'll probably be close to between 3 and 3.5, 4 years of investment of getting things ready before a transaction closes. So there's real tangible value to be had there. And you know, it can make significant differences if you invest in brand at the right time. So I'm a strong believer in that, and I will continue to shovel money into the brand because I know that investors or potential acquirer will value that.
And I think the modern marketing leader needs to be cognizant of that. And if you can demonstrate activities, ongoing activities, year in, year out, that you're investing in the brand, not visual identity necessarily, but generating brand power, brand equity across all those different factors we spoke about earlier. The sum of the parts, when it does come to that M&A opportunity, you've added additional multiples to that enterprise valuation, which is only a good thing. It's just hard to measure, because it is very
Well,
much a buyer will only pay what they think something's worth.
I agree. It is difficult to measure, but the understanding is that you know that if you are investing in the brand, at some point there will be a transaction or an opportunity to realize the value that you've created. And it's intangible until such time as it is tangible and there's an offer on the table and that number is, 12 million and it's not 6, and the difference was, okay, we invested in these things, whether that's the brand, the overall brand strategy, whether we went after the right markets, understanding where the money is and making decisions to align the business to where that pot of money is, if you will. And I said earlier, we did a pivot within one of my businesses because we were cognizant there was a pot of money that was being provided by a government source that we knew our clients could go after. And so we basically rebranded and created a whole new sub brand and rebranded the business to focus on that because we knew there was value there to be created.
Absolutely. And you never know, serendipity, you never know when a potential buyer is going to come chasing after your business. And if you haven't invested in the brand, they're going to offer you a much lower multiple.
Absolutely.
So that's the
Absolutely.
reason why you should continually invest in the brand, because you never know when someone is going to come and knock on the door and say, I'd like to buy you. And if you can maximize that potential, the better.
And it can be relatively low cost. You could spend a couple of hundred on the brand over a period of a year or two, and you will generate, I suspect, 10 or 20x the incremental value on a transaction if someone comes along. It will often make the difference because what are they buying? They're buying the people in the organization, the client list, but they're buying a big part of it. And sometimes 50, 60% of what they're buying is the brand. So the more you invest in that brand, the more the value of the business, the overall enterprise value, will potentially increase. It's not going to decrease, that's for sure.
That's probably a nice place to close this show, Rob. So if you've been listening or watching this episode, I hope you found value from our discussion. In the next episode, Rob and I will be discussing how digital transformation can add value to a business. So stay tuned for that one. Rob, thank you again for giving up your time to share your perspectives today. I've really enjoyed the show and I look forward to the next episode.
See you, Paul.